All right, everyone, I got a great video for you guys today. See, a lot of people, when markets sell off, they try to worry about if they're diversified or not. See, I actually have a problem with that. I think the concept of diversification is actually really lazy. And the reason I think it's lazy is because it makes assumption on price movements based off of stock sector. That doesn't help anyone. So in this video right here, I want to show you not only that diversification is no good, but what you can replace with diversification in order to spread out your risk so that if one of your stocks sells off, the rest of your portfolio doesn't. So I'm clicking these buttons. I'll see you guys inside the computer. All right, we're back inside the computer and we're talking about diversification and specifically why I feel like diversification is lazy. Now I know this is something that's talked about at length on financial media. You know, Mad Money, Jim Cramer, they even have an entire section where people call in, they give their portfolio of stocks, and then Jim Cramer says if they're diversified or not. And there's nothing wrong about that. Well, I think there's things wrong about that. There's nothing bad about it. It's not a terrible thing. But to me, diversification is very, very lazy. And actually, it's very, very subjective. And I think that's where people can really get caught here. So I want to make sure everyone understands at the end of this video what diversification is, why I think it's lazy, and what I replace instead of diversification, what I use instead of diversification, and then I'll give you a little cheat sheet at the end to kind of show everyone what it's all about. So let's jump right in. So look, diversification, we've all kind of heard about it before. We don't really need to go over it right here. If you're not sure what diversification is, you know, search in YouTube exactly what it is. This is not that video though, but the idea of diversification, that idea by itself, I think is a good one. You know, you have many different positions in many different sectors, and the idea is you diversify your risk so that if one sector takes a beating, well, your entire portfolio, quote unquote, shouldn't take a beating either. So that idea of spreading out your risk, that itself is a good one, right? So you have a little bit of tech, a little bit of healthcare, a little bit of industrials, so that if healthcare goes down, maybe tech and industrials don't, etc., etc. But my issue with diversification, at least in the way that it's currently discussed, is that there's a big assumption at play here. And I think when you make assumptions in the market, that's wrong, that's incorrect, that's not the best thing to do. And the assumption is because a stock or a group of stocks are all in a particular sector, that they will act like one another do in that sector. So for example, if you have 2 or 3 stocks in the same sector, that is not diversification because again, there's an assumption that those stocks, just because they're in the same sector, will act accordingly to one another. And to me, this is kind of where the laziness comes in. So rather than diversification, which again is a concept, we prefer to look at pure price movement because again, diversification in the way that it's normally talked about is an assumption of price movement based off of a sector rather than actually finding out what that price movement is, okay? So we prefer to look at pure price movement. And again, price movement is something a stock sector cannot predict. And we want to look at those price movements by themselves. So it's interesting because diversification is really at a high level trying to quickly tell you how correlated stocks are to one another. And again, that's price movement. So we tend to look at correlation as opposed to diversification because again, on one hand, diversification is saying, hey, we think these stocks are similar to one another because of their sector. Whereas correlation will say, hey, we think these stocks are similar to one another because of pure price movement. So those are completely different things. And correlation, again, it's a comparison of price movement over X amount of time, okay? So, again, what's the difference between these two? Well, we have kind of already hinted on them. Conventional diversification, okay, would say making an investment in 2 companies like Google and Zillow at the same time would not be diversified. Okay, and in the case of Google and Zillow, both are tech companies, both are advertising platforms. Anyone walking down the street, if you told them what your definition of diversification was, which again is holding many different companies, many different stocks, and many different sectors, right? Google and Zillow are very much the same company. Again, they're both technology companies, okay? They both sell ads. They, in theory, are not diversified because they're pretty much the same thing. Now, if we look at the correlation side of this, correlation, you compare price movements between the two, in this case, Google and Zillow, to see if the price movements between the two are similar or not. And again, even if they're in the exact same sector and have the exact same business model, correlation would tell us if their price movements are diversified or not. So regardless of what sector they're in, we'll be able to figure out based off of the correlation, which again is just a comparison of the price movements between the two, we'll be able to tell if those are diversified or not based off of sector, but based off of pure price movement. So here's how correlation works. We compare the price movements of two stocks, or actually any amount of stocks, but just we're talking about right here, two stocks, over X amount of the time. And in this case, we're going to do over the last year. And we're going to get a result that is between -1 and 1, okay? And the closer you are to -1, the more negatively correlated the stocks are to one another. So if we buy one stock and we buy another, and they have a -1 correlation to one another, that means when stock A is up 1%, stock B will be down 1%. And at the same time, if we buy stock A and we buy stock B, and there's a 1 correlation, when stock A is up 1%, stock B will also be up 1%. So what we want to do is we want to kind of stay between -0.6 and 0.6 to say that these stocks are not correlated to one another, they are diversified. So anything from -6 to 0.6 means they're not negatively correlated to one another, and they're not highly correlated to one another. In fact, they are not correlated to one another at all. So that's kind of what we want to do right there. So we went ahead and we made a sheet, a Google sheet that you guys will be able to download here. And what it will do is, again, it will look at the returns, the daily returns of any two stocks, and it will give you their correlation. So again, this doesn't factor in what sector they're in, because what sector they're in does not matter. What matters is their price movements, because again, price movement does not lie. And again, I'm going to let you guys know exactly how you're going to be able to download this absolutely free below the video, but let me explain what it looks like right here. In these two spots, I2 and I3, we're going to be able to type in the symbols of each of these stocks, and you can see instantly, and again, this is on Google Sheets, instantly we're able to see all of the price movements for that symbol GOOGL over the last 365 days. Okay, and again, this has nothing to do with the sector or what Jim Cramer said or any about that. We're looking at pure price. So that's Google, and again, Google is an advertising company. It's a technology company, but they sell ads. The symbol for Zillow is Z, which again is a technology company, and it's an advertising company. They sell ads. And we can also see here in column B is the price of Zillow over the last 365 days. Okay, so again, it has nothing to do with what type of stock it is, what sector it is. All it has to do with the price movements. And again, remember, we talked about what do we want to see? We want to see for a non-correlated positions or diversified positions, we want to see stocks between -0.6 and 0.6. And when we put them into our little tool here, Google and Zillow, we see a correlation of 23.5%. So that is good for us because, again, 1 or 100 would be highly correlated. -1 or -100 would be negative correlated. What we're seeing right here with Google and Zillow is very close to 0. So there is almost no correlation between the price movements of Google and Zillow. Thus, these are very, very diversified positions. So again, on one hand, because the two of these are tech stocks and they sell ads, one would think they are not diversified. In fact, if you called into Jim Cramer on his Am I Diversified show and you told him these two stocks, he would probably say, well, they're both tech stocks. But again, that's lazy to us because, again, at a high level, at a high level, that's pretty much saying because these two just happen to be tech stocks means that they are not diversified. If you look at the pure math, actually, they are quite diversified. So again, to us, diversification is a weak concept, especially when we're talking about spreading around risk, as it makes assumptions on price movement, okay, based off of things like industry and sector. But on the other hand, correlation makes no assumptions, okay, because it takes into account price movement and price movement only, which again does not lie. Now, for those of you who want to actually take this tool and use it yourself, you can go ahead and do that. So there's a link below this video called Cheat Sheet. Go ahead, click on that link. What it will do is it will open up a Google Sheet. It will open up actually that Google Sheet that I'm showing you right here, right now. Now, you're not going to be able to do anything with that sheet, but what you can do, assuming you're logged into your Google account, is you can click on File and then scroll down to Make a Copy. This will make a copy for you so that you can go ahead and do the exact same thing in your Google account. What you're going to want to head and do is then choose a location on your specific Google Drive to place the copy, and you're able to name it whatever you want. At that point, you'll have this exact same Google Sheet on your Google Drive at the location you want, called exactly you want, and you'll be able to go ahead and input two stocks in cells I2 and I3 that will allow you to figure out the correlation between the two. Again, the difference between diversification and correlation is very, very important to hammer home. On one hand, we have diversification, which is very, very weak and very, very lazy in terms of figuring out how to spread around risk, because it makes assumptions on price movement based off of things like industry and sector. Again, we never want to make assumptions. Correlation, on the other hand, is what diversification is really trying to get to, where correlation on one hand does not make any assumptions and takes into account comparison of price and price only. Okay, and again, obviously, if you want to go ahead and use that sheet on your own, you get it totally free. I don't need your email address. I don't need your name. I don't need any of that, but it'll allow you to start understanding what correlation is and how correlation does not make assumptions, and it is pure price. All right, guys, that was a fun one. Remember, I don't really like diversification too much, especially the way they talk about it now. The reason I don't like it is because diversification, again, makes assumption on price movements just based off the sector. Now, in that video, we also talked about something called correlation, which I use. And correlation compares price movement. It doesn't care about sector or who the CEO is or any of that. It's pure price. And based off of price movements, you can make a good assumption of, hey, do I have a diversified portfolio? Are my positions not correlated to one another? And again, if you guys want to start digging into that a little bit further, there's a cheat sheet link below this video. Go ahead and click on it, make a copy for yourself in your Google Drive, and you'll be able to start figuring out if your stocks are correlated or not. I'll see you guys in the next video.